Well, U.S. employers pulled back on hiring last month, with the latest jobs report pointing to 209,000 jobs added to payrolls in June. That number came in below estimates, but the unemployment rate fell to 3.6%, while hourly wages increased by 4.4% year on year. And you saw the reaction that we've been seeing in the markets right now. With the labor market still relatively strong, there is a growing expectation the Fed will move forward with another rate hike when the FOMC meets later this month. The Biden administration calling today's report a win, though, saying it is all part of the new Bidenomics plan. Labor Secretary Julie Su speaking to our morning team earlier today. Take a listen.
We see continued growth, and combine that with the 3.6% unemployment rate, which, for the last 17 months straight, unemployment has been less than 4%. It hasn't been like that since the 1960s. And so those combined figures really demonstrate that President Biden's economic policies are working. And what we do want is that steady, stable growth as represented by today's report.
Let's bring in Joe Brusuelas, chief economist at RSM. Joe, it's always good to get your perspective here. I guess a bit of good news and bad news in this report, right? On the one hand, we saw hourly wages go up. We saw unemployment tick down. But we did also get two revisions to the downside from the previous report and a bit of a slowdown, at least in hiring. Are we starting to see the turning point here?
Well, I think that the labor market is cooling relative to an unsustainable and overheated pace that we saw. I think the big takeaway here is that American labor dynamics remain quite robust. Not only did we add 209,000 on the month, you take a look at the first 6 months of the year, 1.77 million jobs added, an average pace of 296,000 per month. I get the sense that as the economy moves into the second half of the year, you're going to continue to see that to moderate, and that in and of itself is probably some good news, especially over at the central bank, where I think we're approaching what I think will be the peak in the current interest rate cycle, and that's undeniably good news. That's why I saw the markets move up today.
Yes, we are potentially approaching the peak, and yet the question appears to be what happens beyond this upcoming meeting, because there is an expectation of another rate hike baked in. Based on the data we got today, what does that tell you where we are, at least in the labor market right now?
All right. So right now in the labor market, we're in a situation where rising wages are bringing people off the sidelines. When you take a look at the labor force participation rate overall, we had a multi-decade high. It hasn't been this high in over 20 years, right? Labor force participation rates of females aged 25 to 54, 77.8%. I mean, it's really very, very strong when you look at that prime-aged workers. As we move forward, there's going to have to be a policy conversation around where are we going to find the workers to rebuild the infrastructure and revitalize our manufacturing sector. You know, when I take a look at this, it's very clear that there's four things that are going to need to be addressed. The first is wages are going to continue to rise to bring people off to work, off the sidelines. Second, workplace flexibility is clearly part of the new labor force. That's not going away. Firms are having to adjust to that. And this is where it gets tough. The heavy lifting will be around immigration and then quite possibly childcare. But you know what? When you have a confluence of conditions like we have, where we just don't have enough native-born workers to fill the need, there are 10 million job openings out there still. We're going to have to get creative here. That, to me, is the underlying narrative of, again, a very robust American set of labor dynamics.
Yeah, and we've heard concerns, particularly in the services sector, especially in terms of not being able to fill those jobs that are out there. I wonder what you make of this other thing that we saw in the report today, which is how many more employees are now part-time workers. In other words, a lot of those hours that they had to work were pulled back because of economic conditions, at least according to the report. What does that tell you about how businesses are operating right now and how big of a cool down we're seeing right now?
All right, well, that's a great question. When you take a look at people who are working part-time, what it really illustrates is that we have a cohort of people who would like to move into full-time work but can't. They need a very heavy dose of workplace flexibility. U.S. corporations, my firm, my clients, the clients of my firm, That's what we hear, is they're trying to provide maximum flexibility to retain and recruit individuals into the workforce. And that's why I mentioned things like, higher wages, workplace flexibility, and then, we're going to have a talk around childcare and immigration going forward so that we can get those people back into the workforce on a full-time basis.
You look at the data today, you look at what we got in terms of the latest inflation data, it feels like everything is tracking at least in the right direction. And of course, that raises the question about whether, in fact, this soft landing can be achieved. It feels like we're increasingly hearing about a potential for a full employment recession.
Okay, so yeah, full employment by my estimation is at 4%. We're sitting at 3.6% as of the June labor force report. Okay, so when you take a look at the underlying fundamentals, let's say you're out there, you're trading, you're investing, and you're thinking, what's the second order derivative here? That's the rate of change of the rate of change. That's slowing at an increasing pace. That's aligned with a good chance for a possible soft landing. I think that's around 40% right now in terms of overall probability, and that's non-trivial. That's something to hang your hat on at this point, given the twin inflation and interest rate shocks that the economy's absorbed over the past couple of years.
So you put it all together, a rate hike expected in July. Are we going to see
without
a second one?
Yeah, well, that will depend on the evolution of the inflation data. Next week, we're going to see the CPI data released. The top line's likely to have a 3% number on it. So the public, which follows CPI, political actors who follow CPI, many firm managers who follow that, at a certain point, they're going to stop planning on raising prices because they expect inflation to continue to increase. In fact, I'm beginning to hear that from clients at this point. So, and we know from the best research, which tells us that once inflation gets between 3 and 4%, they really don't care about it. Now, that doesn't mean the central bank won't, nor should they. Economists like myself would counsel we need to move forward, but with caution, because inflation, that is services ex housing, which is the policy-sensitive metric that the central bank's now following, that tells us it's still not coming down at a rate that's acceptable or tolerable. So there is some heavy lifting to do, both in terms of communications at the Fed, who's going to have to tell the public why they're lifting rates, even though inflation's at 3% and will likely have a 2 handle by the end of the year, and then why they need to restore price stability and why they have to focus on that particular metric, services ex housing.
Okay. Points to still a bit of a noisy outlook there. Yeah. Joe Brusuelas, as always, good to have you on, Chief Economist at RSM.